Silver futures on the COMEX closed this Friday at $82.46 per ounce, marking the official end of the paper commodities trading week. As markets across the United States concluded their regular Friday session, trading platforms for precious metals, including the COMEX and the London Metal Exchange, suspended operations for the weekend, as they do each week. Trading is not scheduled to resume until Sunday evening, when Asian financial markets open for the new weekly session. This regular weekend closure means that no new paper contracts for silver can be bought or sold through Western exchanges until that time. At the same time, significant geopolitical developments are being reported across the Middle East. According to the source report, the Strait of Hormuz, one of the world's most strategically critical maritime corridors for energy transportation, is reported to be facing disruption. Additionally, Maersk, one of the largest global shipping companies, is reported to have halted shipping operations through the Red Sea and the Persian Gulf. Qatar has also reportedly announced a halt to oil production following military strikes near its offshore platforms. These developments, if confirmed, represent notable disruptions to global energy supply chains and international shipping routes. The convergence of a closed paper commodities market and escalating geopolitical tensions in a major energy-producing region has drawn attention to how precious metals markets may respond when trading resumes. Analysts and market observers have long noted that geopolitical events occurring during weekend market closures can result in significant price movements when Asian markets open on Sunday evenings, as demand and sentiment shifts accumulate during the period when Western exchanges remain inactive. The COMEX registered silver inventory, representing physical silver available for immediate delivery, is reported to have declined from approximately 120 million ounces in January of 2024 to approximately 78 million ounces as of March 2026. That represents a reported decline of roughly 35% over a period of 26 months. Meanwhile, open interest in silver paper contracts is reported to stand at over 600 million ounces, indicating a significant gap between paper claims and registered physical supply. As the weekend begins and Western trading floors remain closed, all eyes are turning toward Sunday evening, when Asian markets are set to open and provide the first opportunity for price discovery following this week's developments. In the next part of our coverage, we take a closer look at how commodity markets function during weekend closures and what the current supply and demand data may signal for the days ahead. To fully understand the significance of this weekend's market closure in the context of current geopolitical developments, it is important to first examine how the paper-silver market operates during normal trading conditions, and why a weekend shutdown creates a fundamentally different environment for price discovery. Under standard market conditions, when demand for silver enters the COMEX system, the exchange responds by issuing paper contracts, synthetic representations of silver that do not necessarily require physical metal to be held in a vault. This mechanism allows the exchange to absorb incoming demand by increasing the supply of paper contracts rather than drawing from physical stockpiles. The result, according to the source report, is that price movements can be moderated or contained regardless of the volume of real-world demand entering the system. This paper contract system has been a defining feature of Western precious metals markets for decades. However, during the weekend closure period, that mechanism is entirely inactive. The COMEX is closed. The London Metal Exchange is closed. No new paper contracts can be issued. No algorithmic interventions can be executed through Western platforms. The price discovery mechanism that operates Monday through Friday is, for a period of approximately 48 hours, completely offline. It is during this specific window that geopolitical developments, which do not pause for market calendars, can accumulate without any corresponding paper market response. This weekend, that window coincides with the reported disruptions in the Middle East. The Strait of Hormuz, through which a significant portion of the world's seaborne oil passes, is reported to be facing closure. Maersk, identified in the source report as the largest shipping company in the world, has reportedly withdrawn all container vessels from the Red Sea and the Persian Gulf. Qatar has reportedly announced a suspension of oil production following military activity near its offshore energy infrastructure. Each of these developments, individually, would represent a notable disruption to global energy markets. Together, they represent a reported simultaneous shock to multiple critical nodes of the global energy supply chain. The supply and demand fundamentals for silver, independent of geopolitical developments, are also reported to reflect a significant structural imbalance. According to figures cited in the source report, global industrial demand for silver in 2026 is running at over 1 billion ounces annually. Solar panel manufacturing alone is reported to consume approximately 300 million ounces per year. Electric vehicles and battery storage systems account for an additional 200 million ounces. Military and defense electronics consume 100 million ounces. Water purification and medical devices account for a further 50 million ounces. On the investment side, coins, bars, and exchange-traded fund inflows are reported to represent demand of approximately 400 million ounces per year. Combined, total silver demand is reported at approximately 1.4 billion ounces annually. Against this, new mine supply is reported at only 900 million ounces per year, leaving a reported structural deficit of 500 million ounces. According to the source report, this deficit has persisted for 3 consecutive years, meaning above-ground inventories have been drawn down continuously over that period. The COMEX registered inventory figure, declining from 120 million ounces in early 2024 to 78 million ounces today, is presented as direct evidence of this ongoing drawdown. To place the current price in historical context, the source report references the silver market conditions of 1980, when silver reached $50 per ounce during a period of geopolitical and economic stress. Adjusted for official consumer price index inflation from 1980 through 2026, that $50 peak would correspond to approximately $175 per ounce in today's terms, according to figures cited in the report. A separate inflation metric, referenced as shadow statistics data that tracks inflation using the calculation methodology in use in 1980, would place that inflation-adjusted figure at over $400 per ounce. The report also draws a parallel to the silver market behavior observed between September 2010 and April 2011, during the period of the Arab Spring and the European sovereign debt crisis. During that period, silver moved from $18 per ounce to $49 per ounce, a gain of 172% over approximately 7 months. Notably, the report points out that the move was not linear. Silver traded in a sideways range between $22 and $28 for an extended period before accelerating sharply, rising from $28 to $49 in approximately 8 weeks. This pattern of extended consolidation followed by sharp upward movement is described in the source report as characteristic of precious metals markets operating under paper suppression conditions, where physical demand builds over time before overwhelming the capacity of the paper market to absorb it. Beyond the immediate supply and demand dynamics in the silver market, the source report situates this weekend's developments within a broader monetary and geopolitical timeline stretching back to early 2024. Understanding that timeline, according to the report, is essential to contextualizing why the current moment carries particular significance for precious metals markets. In March of 2024, the report references the collapse of First Republic Bank, alongside reported stress fractures at Credit Suisse and emergency liquidity injections from the Federal Reserve designed to prevent a broader systemic banking panic. These events are described as an early warning signal of deeper structural fragility within the global financial system. Following those interventions, the United States money supply, measured by the M2 indicator, is reported to have expanded sharply, with the corresponding chart described as having gone vertical during that period. Despite official statements that inflation was returning to target levels, the report contends that the monetary expansion set the stage for continued inflationary pressure throughout the following years. Moving into 2025, the report highlights what it describes as an acceleration of the BRICS trade settlement framework. Russia, China, India, Saudi Arabia, and the United Arab Emirates are reported to have formally advanced a gold-backed trade settlement system during this period, reducing their reliance on the United States dollar for bilateral energy and goods transactions. Simultaneously, foreign central banks are reported to have begun quietly rotating their reserve holdings away from United States Treasury bonds and toward gold. This shift is described as contributing to rising Treasury yields and increasing stress within the United States bond market, placing the Federal Reserve in a position of having to choose between allowing bond market deterioration or expanding its balance sheet further through additional asset purchases. As of March 2026, the report cites a United States national debt figure of $38 trillion and a Federal Reserve balance sheet reported above $9 trillion. These figures form the backdrop against which the current geopolitical disruptions are unfolding. The official consumer price index is reported at approximately 3%, though the source report notes that alternative inflation measurement methodologies suggest real-world inflation experienced by consumers in categories such as groceries, housing, and fuel may be running at significantly higher rates. The BRICS gold-backed currency system is reported to have officially launched in January of 2026. Participating nations are identified in the report as Russia, China, India, Brazil, South Africa, Saudi Arabia, the United Arab Emirates, Egypt, and Iran. The settlement mechanism is described as a digital currency backed 40% by gold reserves and 60% by a basket of member nation currencies. Under this system, bilateral trade between member nations no longer requires conversion through the United States dollar, removing a structural source of demand for both the dollar and United States Treasury securities. The People's Bank of China is reported to have been adding between 50 and 80 tons of gold per month to its reserves over the preceding 18 months. Russia is reported to have been converting energy export revenues directly into gold, rather than holding dollar or euro-denominated assets. India is reported to have been importing record quantities of silver for both industrial use and monetary reserve purposes. The report also addresses conditions in the overnight lending market, known as the repo market, which serves as the liquidity backbone of the broader financial system. In September of 2019, repo market interest rates spiked from approximately 2% to 10% overnight, requiring emergency Federal Reserve intervention involving hundreds of billions of dollars in liquidity injections. The report attributes that episode to insufficient high-quality collateral among participating banks, stemming from the practice of rehypothecation, the reuse of the same collateral assets across multiple lending transactions simultaneously. As of early 2026, the report states that repo rates have been spiking intermittently over the preceding 3 months, with the Federal Reserve reported to be providing quiet liquidity support through its standing repo facility. The report attributes current repo market stress to reduced foreign central bank participation in the United States Treasury market, resulting in collateral haircuts, meaning Treasury bonds are being accepted at a discount to face value as lending collateral due to perceived creditworthiness concerns. On the question of United States gold reserves, the report notes that official figures place holdings at approximately 8,000 tons, stored at Fort Knox and the Federal Reserve Bank of New York. However, the report points out that these reserves have not undergone a public audit since the 1950s. At current gold prices, 8,000 tons is valued at approximately $600 billion, a figure the report contrasts against the $38 trillion national debt and reported unfunded liabilities for Social Security and Medicare exceeding $200 trillion. The report further references the historical precedent of Executive Order 6102, issued in 1933, which required the compulsory surrender of gold held by private citizens, and the subsequent revaluation of gold from $20 per ounce to $35 per ounce in 1934, a de facto currency devaluation of approximately 41%. Taken together, the monetary expansion of 2024, the sovereign debt pressures of 2025, the launch of the BRICS settlement system in January 2026, the ongoing repo market stress, and the current geopolitical disruptions in the Middle East are presented in the source report as compounding factors that collectively define the environment in which silver markets are operating as this particular weekend begins. Each element, according to the report, adds a layer of pressure to a paper market system that is, for the next 48 hours, completely closed to new contract issuance or algorithmic price management. As this trading week draws to a close, the confluence of reported developments across geopolitical, monetary, and commodities markets presents a picture that professional observers and institutional participants will be closely monitoring over the course of this weekend. To summarize the key factual developments reported this week, it is worth reviewing the data points and events that collectively define the current market landscape before Western trading resumes. Silver closed this Friday, the 6th of March, 2026, at $82.46 per ounce on the COMEX. That closing price marks the final recorded transaction on Western paper markets until Asian exchanges open on Sunday evening. The COMEX and the London Metal Exchange are both closed for the weekend, meaning no new paper contracts can be issued and no price adjustments can be made through those platforms until trading resumes. The first opportunity for fresh price discovery in the silver market will come when the Shanghai Gold Exchange and other Asian trading venues open for the new weekly session. On the geopolitical front, multiple significant developments have been reported as of Friday. The Strait of Hormuz, a critical maritime corridor for global energy transportation, is reported to be facing disruption. Maersk, identified as the world's largest shipping company, has reportedly halted all container shipping operations through the Red Sea and the Persian Gulf. Qatar has reportedly announced a suspension of oil production following reported military strikes near its offshore energy platforms. These developments, if fully confirmed, represent simultaneous disruptions to several of the most strategically important nodes in the global energy supply and shipping infrastructure. From a supply and demand standpoint, the structural data reported for the silver market reflects an ongoing annual deficit. Total reported demand of approximately 1.4 billion ounces per year stands against reported mine supply of 900 million ounces annually, a deficit of 500 million ounces that is reported to have persisted for 3 consecutive years. COMEX registered silver inventory available for immediate physical delivery has declined from 120 million ounces in January of 2024 to 78 million ounces as of this month, representing a reported 35% drawdown over 26 months. Open interest in paper silver contracts is reported at over 600 million ounces, against that registered physical base of 78 million ounces, a reported ratio of approximately 8 paper claims for every 1 ounce of registered physical metal. In the broader monetary context, the United States national debt stands at a reported $38 trillion. The Federal Reserve balance sheet is reported above $9 trillion. The BRICS gold-backed trade settlement system, involving 9 member nations, officially launched in January of 2026 and is reported to be reducing structural demand for the United States dollar in global trade transactions. Foreign central bank purchases of gold have been reported at elevated levels for the preceding 18 months, with the People's Bank of China alone reported to be adding between 50 and 80 tons per month to its reserves. Repo market stress indicators have been reported to be spiking intermittently over the preceding 3 months, with the Federal Reserve providing support through its standing repo facility. Taken together, these reported developments, the weekend closure of Western paper markets, the geopolitical disruptions in the Middle East, the structural supply deficit in silver, the declining registered COMEX inventory, the elevated paper-to-physical ratio, and the ongoing shifts in global monetary architecture, represent the factual landscape as it has been reported ahead of this particular weekend. Market participants, institutional investors, and commodities analysts will be watching closely as Asian markets open on Sunday evening to observe how silver and related precious metals respond to the accumulation of developments that have unfolded during the period in which Western paper markets have been inactive. The Shanghai Gold Exchange, the Tokyo Commodity Exchange, and the Singapore Exchange will each provide early indicators of how global market participants are pricing in the reported geopolitical and supply chain disruptions when trading officially resumes. This has been a comprehensive review of reported silver market conditions, geopolitical developments, and monetary data as of Friday, the 6th of March, 2026. The data points and events summarized across this broadcast are drawn exclusively from the source report and represent the factual record as presented therein. As always, individuals are encouraged to consult qualified financial professionals before making any decisions related to commodity markets or investment portfolios. We will continue to monitor developments as they unfold this weekend. Stay with us for further updates as new information becomes available. This has been your evening market and geopolitical briefing. Thank you for watching.